Good morning, AXA. I'm Mara Gutierrez, Wealth Advisor, and your host for today. For viewers, both old and new, welcome to episode 2 of Investment Hour. For this episode, we have 3 very special guests with us. We are joined by our President and CEO, Rahul Hora. Rahul, such a pleasure to have you with us today.
Good morning.
We also have with us Dexter Akawili, Director for Investment Solutions. Hi,
Good
Dexter.
morning. Hi. Good morning, Mara.
Good morning. Finally, we are joined by Richard De Castro, Investment Manager.
Hello. Good morning.
Okay. All right, Rahul, let's start with you. We have around 200 distributors watching us live today, and I'm sure all of them are wondering, how did we do in January? Did we fare well? And what can we look forward to in the coming months?
Okay, so first of all, thank you for hosting this and inviting me to this talk. I'm personally very, very excited to be in this investment hour because this is how we are changing ourselves as AXA, and this is how we are bringing digitalization into our business and enabling our distributors to learn and to have a communication with us in a digital fashion. So a big thumbs up to the team which put all this together, and I'm extremely excited to be here today. So to begin with, how did we do in January? So I think January was a great start for us for a few reasons. First of all, we all know that the first couple of days in the beginning of the month were washed away because of the Tal volcano eruptions. So we literally lost a couple of days because most of the people were asked to be indoors, and I'm sure there was minimal business activities on those days. And then, of course, we had a little bit glitch on our GHA in terms of our digital, login process. But in spite of all that, we were at least 30% above our December numbers. So we started off January quite well on our life business. And the other two things which makes January especially special was, one, January was the month where retail distribution, which is agency, PS Bank financial executives and Metro Bank financial executives, all of them put together, it was the highest month of our GI production from our life distributors. We ended up doing 28 million in GWP from our life distribution. And that's what I feel was an amazing achievement, because that is true to our effort and our positioning around One AXA. And the other one was our health business. Again, we have now reached almost about 25% of our business on APE coming from our health and protection products. And especially in agency, we crossed the 30% mark on the health and protection business of agency coming from these products. So I'm extremely excited because truly, as an organization, we are moving towards catering to multiple needs of the customers. So we're not only a company which reaches out to customers for their wealth accumulation needs, but protection needs, especially around health protection and, of course, asset protection by the GI sales. So all in all, a great start to the year, and I'm extremely excited for the rest of the months of 2020.
Wow, thank you very much for that, Rahul. I'm sure our distributors are looking forward to the coming months. January sounded quite fantastic. So that being said, let me call on Richard to update us more or less on what is happening on a local scale.
Yeah, thank you, Mara. I think it begs the question, what are we facing right now? And the biggest headline right now is coronavirus. So let me start with that one. With coronavirus, I think the closest analogy that we have is with SARS in 2003. And 2003 was a very similar case wherein a lot of cases were reported for SARS. But fast forward from January 20 to February 5, there were already 28,000 cases for coronavirus. And that is very, very concerning. Concerning for 3 points. One is it's very contagious. Nakakatakot siya because as the WHO reported, it's for one confirmed case, they can contaminate 4 people. Compare that with SARS, that they can contaminate 2 people. The common cold flu, 1:1. So it's very contagious. That's the first point. The second point is, yes, it's very contagious, but it has less fatality. If we look at SARS, 1 in 10 people actually died from SARS who got it actually. Pero when we compare it with the coronavirus of 2009, only 2 of 100, 2%. So yes, it's contagious, but it's very less fatal. So what is the difference between SARS 2003 to the nCoV 2009, 2019? The third point actually is the faster government response from China. They immobilized the Hubei province and they clamped down on movement within and outside the city. And that helped contain the virus. On my next slide, actually, you will see there the exponential rise of the coronavirus. When they reported this in January 20, when it was announced by the WHO as a pandemic, there were only 280 cases. Fast forward 17 days, there were actually 28,000 as of yesterday. So that's a 100 times fold growth. So nakakatakot siya at nakakaba if you're a Filipino and you will see a lot of Chinese nationals here. So the first question is, baka mahawa ako, right?
Yeah.
So when I look at it, one of the metrics that we're looking for this pandemic is the annual daily growth rate. And from its rise from January 20, it peaked at about 64%. So daily, nag-grow siya ng 64%. And now, it's down to by about 15, less than 20%. So it's a big number, pero it is being controlled because of the swift government response in China. On my next slide, actually, bakit siya importante? We're in China. Before 2003 SARS, China was a drop in the bucket, 4% of global GDP. But now, when China sneezes, the whole world gets sick because they are 1 in 5 or 20% of the global GDP. So when they stop, when they get sick, global demand slows down. Global growth slows down. That's why marami sa market, especially locally, ay kinakabahan. And that's what we see. That's what we've seen in the previous days. In my next slide, you've seen that most of the local equity markets, next slide please, most of the equity markets have gone down, especially in China when they opened after the lunar holiday, and the PSEI, the global equities, and also US. And that's why there was a risk-off sentiment. We saw that for the past 2 weeks. So I would now ask, with all of this high uncertainty, what do we think is the more appropriate response? It actually depends on what is your long-term horizon. So your decision right now to invest, to keep on investing, is actually hinged on long-term indicators, long-term economic indicators. And in this slide, I will show you what we're looking at, the 4 pillars of long-term growth. Ang first pillar ko is, we Filipinos are millennials. Our average age is 26 years old. So kakagraduate lang nito, may mga trabaho, and they will have a prospect of rising salaries. Gagastos tayo. Pag payday, gagastos tayo, mag-iipon tayo, at magkakapamilya tayo. And that is a very, very good point because on my second pillar, we are a consumption-driven economy. 70% of our economy is hinged on our personal consumption. Pag bumaba ako, bumili ako sa 7-Eleven ng drink, ng snack, I will contribute that to my country's GDP. Multiply me by 100 million, that's a very, very big number. That's why it's very important that we are insulated by this external factor, the coronavirus, because 70% of our GDP is with consumption. So my second to the last point would be the Build program. Alam niyo na to, malaki yung ginagastos ng government for the infrastructure spending, our roads, our bridges, our airports, our seaports. And this is very important because may multiplier effect siya actually. Kaya long-term indicators is because for every peso spent on infrastructure is 1 peso and 50 centavos more in the future. So if I'm seeing almost 1 trillion pesos spent in infrastructure, that will be a very big multiplier down the road. And my last point would be the forthcoming income tax cut in the corporate portion. So I think these four pillars is the is a very big argument for us. Na yes, there is that short-term disturbance in the forest. Pero if you look at these long-term indicators, we are still solid.
Wow, thank you very much for that very thorough and concise report on the local market, Richard. Let's move on to Dexter, who will be giving
Hi,
us
Mara.
a brief update on how things are globally.
Yeah. So 2019 is actually a great year for global markets. Both fixed income and global equities registered around 10 to as much as 30% return for 2019. And it's mainly because in the fourth quarter, particularly, many positive news came out. One of which is the US-China trade war, the de-escalation of risk in terms of uh, whether it will become a full-scale trade war that has eased up. And come January, we saw the trade deal happening, the stage one trade deal happening, right? And also, in terms of the European side, uh, the the elections in UK and the finality of Brexit has taken away another source of uncertainty on the European side. And we've seen the European market also rallied and registered around 20% for 2019. However, on the turn of the year, by January, as Rahul and Richard has shared already, there are new uncertainties that were brought in on the table, and let's look at the coronavirus as a central piece of this uncertainty, because the coronavirus impacts the second largest economy, China, primarily, and there's a big difference, also relating it to Richard has shared, from SARS in 2003 and 2019 or 2020 now, is that if we're to look at China's role way back then, in 2003, China just joined the World Trade Organization in 2001. So in terms of their participation in the world economy, it's not that big yet. Now, in 19 or 20 years after, China is the manufacturing hub of the world. And what has happened is that because of that contagious virus, they have locked down certain cities, stopped certain manufacturing firms, certain plants, and the likes of Apple has already signaled that certain plants will not be operating. And in that particular province, automotive is the primary industry that will be impacted. So the likes of General Motors, Tesla, and even VW, or some European countries manufacturing their vehicles through China is impacted by that. So that has now a great impact on the world's supply chain, because they are the manufacturing hub of the world. So imagine how it would be in the next quarter or so if we start to experience that, oh, you want to upgrade your iPhone, you have to hold back and wait because they have yet to deliver to you. And mainly because with this integrated economy that we have now, more and more companies are doing JIT, or just in time.
Right.
And with like just a week or two of shutdown of certain manufacturing plants can really impact adversely our supply chain. Now that then translates to, even if you want to buy here in the Philippines new phones and all, you have nothing to buy, or there's no supply of it. So it will then impact to global consumption, possibly slowing down. We are expecting that on the first quarter of 2020, China will have a drag of 1 percentage point in their GDP. So if they're expecting a 6% growth, that translates to only about 5 or even a bit more. Now, the main question is, how fast can they recover and say start plants opening up and allow people to get out of their homes? Now, that is something that we don't know yet. It's too soon to say. We don't know. But if assuming if it will only last for a couple of months. And whatever is dragged on, I'll say, a decline of about 0.5% in global growth in the global economy happens in first quarter, we can expect a rebound on second quarter. However, that can change if or when we get to see that the coronavirus couldn't be contained that easily, or perhaps we could borrow experience from SARS, where it lasted for like more than a year in China, like a year or two. So that's one of the key concerns, which then impacts certain countries like us when it comes to tourism. As you know, if the Chinese cannot go out and travel, like more than 100 million Chinese travel in each year, if they can travel to us and spend, now certain countries that are dependent on tourism will also be impacted. So it's a bit of a fluid situation right now, but on a global scale, what we can see is its immediate impact on the supply chain. The likes of consumer electronics are heavily affected there, and also automotives.
On a distributor standpoint, I just like to ask, what if clients ask them, which product should I go for and which product should I avoid, considering all that has happened? Should we avoid funds that are invested highly in the said stocks that you were just discussing, or what products would we recommend that our clients buy at this point? Rahul?
Okay. As our investment experts have shared, for me, if you are a long-term investor and if you are looking at a investment horizon of 5 years plus, then for me, it's a great opportunity to buy. Because personally, when I'm investing myself, I just bought stocks and equity-linked, products in the last 1 week, because in any situation which is unpredictable, the market response is always more adverse than the fundamentals. And as we just shared, the fundamentals of Philippines are strong. And if as a customer, you're not worried about, a short-term impact on the market, for me, it's an excellent opportunity to buy. So this is the time when the distributors should reach out to the customers, share all the data to show to the customers why the markets are in the Philippines going to be fundamentally strong. Coronavirus, in all probability, looks like, as we shared, that because of the quick government response, it will be controlled. It will not have an impact which is going to be, on a very long-term basis. And I define long-term as 5 years and plus. It's a great opportunity to buy. It's like, the stock market is on sale. And whenever there is a sale in SM, we see long queues. So I'm surprised, why don't we see long queues of customers to buy our products at this point in time? Probably the distributors need to do a better job in sharing this whole concept and this, this particular window of opportunity that we have from an investor standpoint. The other big advantage, is that whenever you have situations like SARS or coronavirus, the entire health aspect of the business comes top of the mind of everybody.
It's highlighted.
People are talking about health. People are talking about health risks. People are talking about how any medical emergency situation can impact business, can impact results. And that is where health insurance comes out quite significantly top of the mind recall. So it's also a great opportunity for distributors to go back and share with their customers on how the health challenges are evolving, on how customers are on a continuous basis and regular basis exposed to health risks which are either which people are aware of, and in case of coronavirus, health risks which we are not even aware of, and hence the importance of ensuring that you're keeping yourself covered. And again, in these times when the emotional part is there, or when the relevance is there, the distributors should use this as an opportunity to reach out to their customers and reiterate what we've been talking about around health insurance, around the need of buying a health insurance product. So for me, whether you're reaching out to your customers on investment as an opportunity or health as an opportunity, it's a great opportunity to go out in the market and sell. So for me, yeah, that's the message which I will give to our distributors.
Guys, you heard it from Rahul. It's a great time to get in touch with all your customers. Don't be shy. Have the courage to approach these people and talk about our products. So that being said, I understand we have a number of questions from our audience. All you have to do is send them in via Zoom. It's not every day that we have 3 experts with us addressing our concerns as well as our clients' concerns. So let's take advantage of this opportunity. I think we have our first question. Don't be shy, guys. Everything will be asked anonymously. Okay, given the current times that this episode affects the production and development of nations, can we safely say that it is best the best time to invest in our offshore fund portfolios?
Yep. So
go ahead.
All right.
And answer the question.
Take a shot.
Yep. Well, yes. The quick answer there is yes. It is always a good time for us to offer our offshore investment portfolios. The fact that we have a very good diversified suite of investment portfolios, offshore investment portfolios. Like for example, on an asset allocation basis, given that say the U.S. market is on the high side of it, nothing's stopping us to cross-sell our multi-asset balance, or rather our global dynamic allocation multi-asset, wherein if we do expect a slowdown in the global economy, we are also expecting global central banks to intervene. So that is good for bonds, and the dynamic allocation capability of a balanced fund can then reallocate to equities after on a timely manner after some time when the markets have recovered. So there's always a good offshore fund that we can offer to our customers.
I think for me, if I may just add to what Dexter is sharing, whatever we are recommending to the customer has to be driven by where is the customer currently invested. You always have to keep that in mind, because any future investment opportunity or advice that you're going to give to the customer is definitely based on where is the current investment centered around, what is the current portfolio of the customer looking like. Doesn't matter if the portfolio is from AXA or from other companies or from other investments. You as a financial advisor need to be aware of what is the portfolio and how is it structured. And the best advice that we can give to any customer at this point of time, not only now, but looking at how the world and how the investment, volatility and unpredictability has unfolded over the last few years, the one word that you need to keep in mind is diversification. So diversification is the key. The local markets, as I said earlier, is at a discounted price. There is a lot of emotional, emotions which have been set into, and hence the markets have dropped more significantly than what the fundamentals are justifying it. So it's a great opportunity for you or for the customer to buy local stocks as well. But having said that, please ensure that you are recommending a strategy which is enabling the customer to diversify. So depending on wherever he's existingly exposed, please ensure that the new investment that he's doing allows him to expand and to diversify his portfolio, rather than just continue to invest in the same asset class or in the same geographical market as he already existingly invested in.
Yeah.
We have a second question coming in. Oh, I think we're experiencing some technical something. Local stocks have been in a slump in January. Will it get worse? Will it get worse before it gets better, given the ongoing virus here?
I think to answer this question, we have to look at the current valuations right now. When you see valuations, it's the price that we pay for every peso per future earnings. So that is reflected in the PE. And currently, the PSEI is currently at 7.5. If it's at 7.5, the PE right now is about 16 times. So I'm paying 16 pesos for every future peso of future earning. So is that low? Is that high? I think that is low because if you look at a 10-year average, it has been trending at 18, 19 pesos. So to Rahul's point a while ago, it is on sale right now. And if we are looking at long-term investing, you should look at the sustainability of these earnings at these low valuations. It is an attractive point to enter. So if you are unsure when to enter at what exact point or what exact level, it's advisable that you tranche it. You put in some now, put in some later on. But the most important thing is when other people are weary, you should be greedy because these are the times that valuations or entry points are at its most cheap. Yep.
Yep. And I think I would just want to reiterate the point of investing over a period of time because I mean your question was whether it will get worse further. It can. I mean there is no predictability. In fact, just in the last 2 to 3 days, the market has moved between 7.5 and 7.2 quite dramatically. And for me, there is no such certainty whether it will go up or go down. It is in a range where it is cheap, and I would say take benefit of that range and get invested or make your investments in a tranched fashion, which means break it down into smaller parts. If it's a regular premium product that the customer is interested to buy, make him buy a monthly premium product at this point in time. If he's going for a single premium investments, don't invest the entire single premium in one shot. Break it down into initial investment and some top ups, and the top ups could even go on a weekly basis, and the top ups could go on a monthly basis. I would say it's really how you should maximize because if the predictability around markets was so good, then all of us sitting here we wouldn't have to work anymore. We would have been rich already because we would have all known exactly when to enter and when to exit. But that, unfortunately, that predictability in any market is not there.
Yeah. And to add to it, usually whenever we get to have market sell-offs, market is not that good. Natural tendency of other financial advisors is actually to hide from their customers. I would actually encourage you to engage your customers. This is the right time for you to encourage them. If you're not spending, might as well do a top up, a regular top up in their existing RP product. Share to them that what we are sharing to you now, that again, it's all about having that time that you spend in investing in the market and that discipline of setting aside a certain amount. So just share that story, and you can even cross-sell a regular top-up or even a new policy.
Maybe you can tell our viewers a little bit about cost averaging.
Yeah.
So
Yeah, cost averaging, it's all about periodically, like on a monthly basis or quarterly basis, just keep on investing, regardless whether the market's going up or going down. On average, you would end up over, let's say, a 5 or 10-year horizon, you would end up gaining significantly through time. And after all, if you're setting aside money for retirement, cost averaging by a regular top up on top of your annual premium is really a effective strategy of saving and investing. It's all a matter of having that discipline that you can really sustain for the next 5 to 10 years.